Right. Hello, everyone. As folks are coming from the waiting room and joining this conversation, I just want to make a couple intros and then we'll get into it. I'm Andrew Stimson, COO at Legacy Acquisitions today. I've got Andy McMullen. He's the founder and managing partner at Legacy Acquisitions. We are a development firm that builds thriving communities. And Andy's been in this for 25 plus years. As a development firm, we've got 1.2 billion assets under management, and we've built 4,000 plus units. And today, we're really excited to have Brad Moynihan on of Marble Capital. Brad and Marble Capital, they're one of the more active multifamily investment firms. Since 2016, Marble Capital has raised over $3.5 billion and invested in 60,000 family multifamily units, representing about 15 billion in total capitalization. So, thanks for joining this conversation today, Brad.
Hey, thanks for having me. Appreciate it.
One thing I want to ask before we get into kind of your business and some of your story, I'd love to hear what's something that when someone meets you, something about yourself that they may not know about you.
Oh, that's a good one. Let's see here. Well, background wise, I'm from New Mexico, so I'm generally the first person someone's met from the state of New Mexico. So that's one thing out there. Um, Other than that, man, got me stumped early in this one, but I think my faith is a big part of what I do and who I am, and so that's something that I try to carry with me and try to live out the best I can. So that's always something that can oftentimes come up in conversations.
Awesome. Yeah, that's where we met, Brad, at Redemptive Real Estate Conference in Dallas, and so we'll have a question on that here pretty soon. Um, but first one, let's get into this. So, 60-second Marble Capital pitch. What do you do, and who do you do it for?
Yeah, sure. So probably helpful to just give a background on the firm. So the gentleman that started Marble, they had previously been in the brokerage world. And so they started one of the first offices of what was called at the time ARA or Apartment Realty Advisors back in the mid 90s. And they grew that from, that one office to call it 25 offices nationwide. And it was the second largest multifamily brokerage firm at the time, ended up selling it to Cantor Fitzgerald in 2014. And Cantor tucked it underneath their Newmark brand, so it's now known as Newmark, and one of the large brokerage firms out there. And then our founders were looking to do something maybe a little different with the next act of their career. And at the time, it was kind of in the wake of the GFC, and there was also some new banking regulations that happened that really pushed down the leverage levels that apartment developers could get. So historically, they were getting 80% debt on their construction projects, and then all of a sudden it was closer to 60 to 65. And that led a lot of their development clients to be in a pickle of, hey, it's really hard to raise that much equity. There was a gap in what they were able to raise. So our guys saw that opportunity and said, let's go be the middle part of the capital stack and provide preferred equity. And so they launched Marble in 2016 to go do that. And here we are. I think we started with 100 million of friends and family money to prove out the concept, and we've just grown really rapidly and been very blessed. And over the last 10 years, we've raised about 3.5 billion for that strategy. And so we were kind of pref before pref was cool. It seems like there's quite a few pref groups out there now, but that's been kind of our knitting since the beginning. And now we have a bunch of different things that we've got out there, different buckets. Kind of the first thing that we do is our flagship fund. We're on our fifth flagship fund, and that's really a merchant build multifamily development fund where we can do, pref, JV, or hybrids of the two. But we've really kind of stuck to our knitting, especially as of late, as the market's been a lot more difficult to underwrite and been more in the pref space. And then our second bucket, staying on the development side, we recently launched a QOZ vehicle to go take advantage of the opportunity zone legislation that's coming out, and that really have a tax advantages on a long-term hold. with that. And we can do, multiple different product types, and that's kind of more of a multifamily focus, but we can do some other things in there as well. Staying on the multifamily side for bucket number three, we've got an existing asset portfolio. It's an evergreen vehicle where we can, hold and have more durational flexibility for how long we're in deals, and really doing acquisitions and recaps there. And then the last one's a relatively new one for us. We call it a diversified credit bucket. And it's really doing pref, mezz, and stretch senior, the things that we've been doing, since our inception, but expanding it beyond multifamily, and really looking primarily at industrial and retail. But we can do some other asset classes as well, but that's the real focus. And that could be either in existing assets or development assets.
Brad, I'm really curious about, so you guys are focused since 2016, since the inception on multifamily. Obviously, experience probably goes back further. When 22 hit, you guys have owned a lot of assets, I imagine. Maybe you weren't buying at the time, but you certainly owned a lot of assets. Just maybe talk a little bit about what that was like. I know you probably had various loan types at the time. Nobody predicted, right? So there's some heroes out there, but even those heroes that say they didn't get beat up a little bit by multifamily probably were pretty foolish in other cycles, right? They left a lot of money on the table. No one expected interest
Yeah,
rates to jump 2 times. But just curious on how you guys kind of pivoted through that cycle.
sure.
Maybe you're still working through some of those now, but I think the audience would probably be
Yeah,
curious to hear
yeah,
how that
sure.
was.
I think given that most of what we've done is development, 22 was really when things started to turn. But historically, we'd done mostly pref equity, and it was before you had some pretty significant buildup in costs that came with COVID. And so the basis that we were in at on the deals that were kind of pre 21 was really attractive. And further, we were in a preferred equity position. So most of those have been monetized at this point, and we're good to go. And then, we continue to place, bets throughout the cycle. And the stuff that was done kind of 21 to late 22, 23, really is just coming up now to be monetized. And those deals, as a vintage, again, we really leaned hard at the pref, so we feel good about our position in it. But they dealt with a number of headwinds, right? It wasn't just interest rates. It was you had the post-COVID supply chain delays. You had, hey, my interest rate went up and now it's 8 instead of 3. You had a lot of supply came on because there was so much capital when money was free, where I thought I might be leasing against one other deal, but there's four. And so now, I'm not hitting the rates that I thought on the rents, and I'm also not hitting the velocity that I thought, which makes me go through my operating reserve faster and my interest reserve faster and all those things. So you kind of had this perfect storm of headwinds. And we found as we've been working, with our portfolio is most of our investment partners are really trying to get back to just get their money back for their investors. That's kind of a win with that vintage, right? If you can do that. And so, thankfully, there is ample amount of debt capital today. In fact, debt capital in multifamily, I think the first quarter this year was maybe the second highest first quarter in history for debt capital going to multifamily. And so with the first one being, I think in 22, before the world turned and everyone was putting money out the door. So there's been a lot of ability to refinance and kind of hope for another day. That's not every asset by any means, but we're seeing a lot of refinancings as opposed to sales. The sale environment's just been very challenging right now, and I think the values that are out there because a lot of these locations that are in the Sun Belt that have heavy supply have 2 and 3 months concessions, have been very challenging values. And so everyone's kind of hoping to kick the can down the road for a day when those concessions burn off. Maybe we have a little more stability in interest rates. Maybe we're not involved in world skirmishes and all the things that are causing volatility. And so that's the goal, I think, for a lot of the folks that are partners is, can I get my money back? Can I get my investors' money back? And that's what everyone's playing for.
You know, in every cycle, and I've been through since late 90s, so it's been a long time. older. Um, and you can see it on my face, the real estate cycles. But I, it always seemed interesting that people would talk interest rates, and almost inevitably it was always the flow of capital. Well, if the capital came in and there was a heavy flow of not only debt but equity, then you always had these cap rate compressions, right? Because people can, as you said, just work through it, right? You've got certain operational costs, and now you can't be too negatively leveraged, but in general, I think what happened, as you said, the perfect storm, insurance, ICE was an issue with a lot of stuff that we were in. But I think as we're starting to see the flow of capital come back, that's a big deal. We've been just anecdotally starting to see a lot more term sheets that have this kind of either stretch financing or maybe higher LTVs than, I remember when we were doing a deal with I won't say who it was, but the day that I actually had signed on the loan docs, they had moved. The next day they called. They said they'd never done this before. Like the docs weren't even sent back. We had signed at 80 and they moved it back to 70. It was like within 2-3 days we had to come up with this additional capital raise. So I don't know that we'll see something like that. I know we'll see that, but we'll see something like that, right? So some kind of black swan event. So I'm just kind of curious, like how you guys, if you could talk a little bit about the kind of deals that you're seeing on the debt side, just with rates and terms and credit and then how you guys foresee this next maybe 18, 24 months as a organization, what you guys are focusing in, because it sounded like you've got like 4 funds. So I'm just kind of curious when you guys have your meetings, you talk high level where you're headed.
Yeah, I mean, I think maybe there's a lot there. So let me start with um, your question on the capital markets and what does debt financing look like?
Yeah.
Not what we're providing, but what others are. Again, the lion's share of what we've done is on the development side, right? And so construction lenders, if you look back 2 years ago, they hadn't gotten anything paid off, right? Because everything was kind of stuck in limbo. And they had really pulled down their leverage points to even like 50, 55%. So it was a pretty tough putt. And then they were also putting on requirements that you'd have to put in deposits. And generally the deposit was like, 10% of your equity or something. I mean, it was just an insane amount. So it made it really tough for people to do deals. Now they've gotten some payoffs, and so the construction lenders are back in the business. They're back up to 65%. Pricing has come in. 2 years ago it was probably SOFR 300, and today it's SOFR 225 ish, maybe 250 at that level. So that's that piece. And then on the debt financing of kind of refinance debt funds, um, there's a tremendous amount of capital chasing real estate, and a lot of it's pushed itself into the debt space or into the credit space. And so that's made that really aggressive as well. On some of our refinances, we're getting 75, 80% of value. A lot of it's not as much value constrained as just debt service constrained. And right now, with a lot of these deals having heavy concessions and not being stabilized, there's an opportunity for that debt service to really pop, as you get towards stabilization. But that's what the debt funds are doing, is more bridge financing. And they're very aggressive. I think we've seen stuff that's SOFR plus 175, SOFR plus 200, at a pretty good loan to value on today's value. So it's just been super aggressive. And then your second question, I think, was around how do we look at all of this and what are we trying to do? Is that what you were asking? Can you remind me?
Yeah, yeah, and just for folks that maybe are unclear, SOFR is kind of where all banks set kind of a baseline rate. So I think it got up to, I don't know, was it 5 at one point, 4? So I think now it's at like 3.6, something like that. So what Brad's saying is that they're getting some coupon. Is that fixed rate debt that you guys are getting? So is that
The
or
bridge financing is typically floating,
yeah,
and you'll have to put in an interest rate cap, right, which stops that floating rate from going above a certain level.
yeah. Yeah. So yeah, so Brad, more of my question was just really to how you guys are kind of bracing for what's next. When you have your meetings, I imagine there's probably some real opportunity from some distressed multifamily. I know you guys like
Yeah,
multifamily. At some point, we'll debate why you guys like multifamily more than built to rent,
yeah.
but if that's the case, kind of maybe your outlook on the next couple of years, because I believe a lot of folks that are in our are listening today are really interested in the multifamily space.
Yeah, for sure. I think on the multifamily side, our view is right now you have some temporary headwinds that make the market really tough. Um, you have a ton of supply that has to be absorbed. The good news is demand has been really, really strong. And the absorption's been, record absorption for multiple years in a row. And supply kind of fell off a cliff a couple years ago. And so if that all keeps and holds and you don't have any, like you talked about black swan events or anything like that, would stop the demand piece from changing, um, then, it's pretty clear to see that depending on the submarket or the market, 12 to 24 months out, you've probably absorbed most of these units that were built, and you're starting to, burn off some of those concessions, which is the free rent that's been offered throughout the market and permeates the world today. And then maybe even get some rent growth depending on the location. But it's very micro pocket oriented, right? I mean, you can like certain markets, but then every great market has a horrible submarket, right? It's just oversaturated. So, and you could say the same thing with markets that are tougher, probably have a couple of really attractive submarkets, right?
I don't doubt. Thanks, Andrew.
Yeah, that's gonna kind of work right into the next question, Brad. But before that, a couple housekeeping things. Hey, everyone, we've got poll questions that come up, so feel free to plug in your answer for each of those. Also, you can send a question in through the chat. So if there's something you want answered, we will move our questions aside to answer yours. And so feel free to send those through the chat. And with that, let's keep going. So uh, you guys have deployed in a lot of different cities. There's different investment mandates on, hey, we're going to just stay in these markets. Um, how do you guys make those decisions on where you're placing your capital these days?
Yeah, I mean, I think, from our standpoint, it really starts with the theory that, um, we're really looking at Sunbelt markets. And the rationale there is we generally want to be where people are moving to, not moving from, right? And so, you've definitely got some challenges there because capital moved there and there's a lot of supply for today. Um, but in some of the other markets where people are moving from, you also have, some pretty high regulatory risk, whether it's rent controls or, state taxes that are really high or just an inordinate amount of red tape to get things done. And so, those are markets we kind of look at it. Supply is a temporary risk, but regulatory risk is not, right? And so we want to continue to put our dollars, where that demand pattern is continuing, which, generally tends to be in the South today. There are some, select, I'd say Midwestern markets that we think are intriguing and have made a couple bets, but our portfolio historically has been 90% in the Sun Belt.
Andrew, I think it's interesting that the kind of idea of, we're always trying to go to where people are going to be. I think that applies even now, what we're seeing with these data centers. It's kind of this great equalizer in AI is, every economy that we've ever had since the beginning of time, there's been some kind of disruption in technology that has basically changed the way that we view the world, right? So if you can find markets that are in in the way of where this money either is going to be made or where people are going to spend it. And that's why I think it always comes back to the real estate part is that, the technology, whatever that is, maybe there's some displacement in some areas, but there's certainly going to be solving more problems. And what that means is more growth and more productivity. And ultimately, wherever those markets are, they're going to be need to be spending that wealth on something, and usually it's more real estate, right, or investing in their folks. So in the areas that we've always felt like, hey, maybe we can avoid some of renters that we have to give so many concessions, and we got another builder coming in 3 years later, and he's sucking out all of our residents, and we've got more concessions. To Brad's earlier point, there's always these ascending markets and these descending markets, and many of them are in the same market, just different submarkets. And so you can find these areas. I agree that the Sun Belt seems to be where people are going, but I also think that with the technology, there is an equalizer too, and that some of the have-nots, if they're using it the right way, can now become that that group that's basically able to invest in other places because so much of the additional economy is not just about where they want to sunbathe. So,
Yeah,
anyways,
I think that's good. Although you got to be a little careful. I think Elon's talking about putting data centers in space. I don't know that I'd want to
yeah,
go invest there quite yet, but maybe.
which is so interesting because one of the markets that we're working on is that there's rumors of them putting kind of their factory base. But that whole solar conversation is another one, right? You got these data centers, and then I heard economists say, "Hey, this was maybe in March," and he said, "Hey, look, if you're going to invest in real estate, what get rich would be probably getting back in office. Stay rich would be staying in housing, multifamily, built to rent, and get poor would be data centers." And his rationale was probably much like what you experienced, Brad. You were at GE at one point, right? I mean, GE was $1 trillion company that went down to like 100, what was it, 170 billion at some point, and people never thought that would ever happen. And now you've got these leaders, whatever it's going to be, SpaceX, or it's going to be, Anthropic, or that's what it is for now. But that's a lot of stuff to fill, and if you can get solar coming from space, that changes everything, right? So that's why it's so fascinating. Like, we're in this business that real estate, at whether it was railroads, whether it was horse plows, it all comes down to, can you live and work in a place, and this is where people need to be in housing. So I just think it's fascinating that you guys are looking in those markets because that is where people are going to be.
Yeah, and I do think I would add on it that, one of the things that we're spending a lot of time on, or we think a lot about, is just liquidity in those markets, right? And so, we want there to be capital that wants to buy the deals there, right? So I think if I step back, the two questions I got to answer is who wants to live here and who wants to buy it? And those are things I got to have great conviction in.
Yeah, and I think in addition, the reason that they want to be there is because they can spend their money a certain way by building out their business,
Yeah,
or they love the idea of their amenities. I imagine you guys are building out amenities. They can work from this place that used to be them going into office, but now it's enough room that has conference rooms and etc. So I just think
yeah,
it's fascinating that from COVID, we thought for sure that this world would change in that regard, that everybody would want to work from home. And that certainly happened to some degree, maybe days off. But offices come back,
for
retail's
sure.
come back. I go to the movies with my kids again, and they thought that was dead. It's just, there's so many of these things that take so long for us institutionally to adapt to, that we kind of have to figure out what are those creases that we can cling to that will,
Yeah.
as you say, create housing for people.
Yeah, for sure. Well, in those other sectors, the herd had to be thinned, right? So there was winners and losers, and the ones that are still around, I think, are going to do just fine.
Yep, no doubt. Thanks, Andrew.
All right, we got a question that came in from Jacob, kind of a two-part question. The first one is, what's the smallest amount of capital that you all will deploy in a single property or deal?
Yeah, five. We try to be five to call it 35 million in our deals. We've done some a little smaller than that if it's like a repeat sponsor, or if there's two or three deals together, or we've got a new program that we're doing, single tenant net lease type stuff on the retail. So we would want to show an aggregation of multiple deals to go there, but the individual deal might be smaller. But on the multi side, five is kind of the cutoff, and we can go into the 30s.
And do you guys do any short-term VRBO style properties on the beach?
No, we haven't yet. We've looked at a couple, and I think at the end of the day, where we're playing is really more in that institutional class of real estate and looking for, we kind of talked about it earlier where there's liquidity. And I just haven't seen, the exits proven up in that space yet, um, at a mass level, right? So I think we were slow to adopt in some of the other offshoots too. I mean, like there's been a wave of office to multi conversions, right? And we just haven't seen a lot of those transact and know, do they actually sell for similar numbers or do they at a higher cap rate? This is the same story that BTR had 5 years ago, right? Because they just had nothing in trading. So I think waiting to see where that shakes out before we really kind of move into that space.
When you're underwriting those deals in that 5 to 35, um, I think there's a question we talked about at one point, Andrew, which was, say you got just an incredible deal, an incredible market. Maybe you got one or two exits for the operator. Is that an institutional quality deal these days, based on kind of what you've seen with some of the fallout from inexperienced operators, etc.?
Yeah, I mean, I think it depends on if we're talking acquisition or development. I mean, on a development side, we are certainly going to want to see some skins on the wall and track record. And it doesn't have to be, if someone was the main guy that we did a deal with under a different heading, and they're coming apart and starting their own deal, and we've known them, then that probably is a profile we would think about. Um, but yeah, really wanting to see someone who's got a track record of doing it. Um, and then, if they don't quite have it, I think the one thing that we've had a lot of conversation with people are, can you assemble a team around you if the deal itself is very attractive, but maybe there's a hole on their team. Can you assemble something to help you fill in the gaps? So, can you bring in a co-GP partner who's got a little more experience? Can you, if it's a development deal, can you have the GC, the general contractor, can they meaningfully invest on your side, so that they become almost, you know, much more vested in delivering it on budget on time? Um, can you bring in consultants, to help you, just fill in your gaps, right? So that's I think something that would help. And then another piece is just a balance sheet, right? If it's a really nice, if it's a really good deal, and do they have a strong balance sheet, that um, they could help weather any storms that came up. But generally speaking, and I think this is probably um, true for most institutional groups, is we don't want to pay the dumb tax, right, on someone learning the business on our dime. I mean, we are fiduciaries to our investors, and so we've got to pick people that know what they're doing and have demonstrated what they're doing, because they're managing it day to day, right? We have some oversight, but at the end of the day, they're making the majority of the decisions.
That's good, really good. And I think if we were just to tease that out a little bit, the deals that come across your desk that are really either non-starters or quickly disqualified, I just think it might be helpful for the folks on this call to kind of hear what some of those holes that you're referring to are, that might even not get the opportunity to have that conversation where, hey, look, maybe get your GC invested, or maybe, and then go. I'll let you answer that question
Yeah, yeah,
first
sure.
before I kind of pepper
Well,
you with many
there's a
more.
host of things that are just it's just not in our strike zone, right? So a lot of the filter may be no fault at all of the sponsor. It may be, in a market, someone asks us for JV dollars in Waco, Texas, for instance, and that's just not something we're going to do. Um, so that, is almost an easy no.
Oh,
Um,
Waco taking shots. Waco. Sorry,
I,
guys.
yeah, I went to school at Texas Tech, so let's say love in Texas.
Okay,
I'll,
all right.
I'll throw the shade at me. That's fine.
Okay, all right.
But
You're a Mahomie.
yeah, yeah, he's great. Hopefully, he comes back from his ACL injury
Yeah.
before. But yeah, so there's a whole host of filter things. Or hey, I need $60 million of equity, that's just too big for us. Or I need $2 million of equity, it's too small. Or if we already have, three assets in that submarket or something, if we have exposure issues. There's things like that that are going to make it easy to say no. But I think what you're asking more about, and that would be specific to us, maybe not specific to another institutional capital group, but like what are the things that as we dig in, we go, no, this doesn't make any sense. So, um, there's the obvious things like sponsorship issues, right? If they've got a track record of giving deals back or something like that, would be red flags, or if they don't have a great reputation in the market, things like that. But specific to the deals, I think one thing I see a lot is just, there's no alignment, right? So they're not wanting to put any money in. There's huge fees, things like that. It's like, look, I mean, if we're going to be partners, you got to have a little bit of financial skin in the game. And then I think the other one is really just holistically unreasonable assumptions, right? And so I'm all for championing your deal and making a case. But if you think you're going to operate the deal, expenses that are, 50% less than the rest of the market does, and your rents are going to be 20% higher than the rest of the market, and there's no reason for that. The pie in the sky just feels like, hey, if they're this cavalier with the assumptions and not providing, really thoughtful analysis, what else have they not been thoughtful on? What else are they letting optimism crowd out their ability for, good old fashioned hard work, rolling up their sleeves and understanding stuff. So that's something that I think can sometimes, put a bad taste in your mouth. For instance, we had a deal we were looking hard at, and we ended up passing on it because we got a call with the sponsor, and we were talking to them about where they thought they'd be able to sell the deal, and they thought it was going to be 100 grand a door higher on the exit than we'd underwritten, and then we had validated with other folks in the market would be a realistic assumption, and it kind of put a negative taste in our mouth, just like, well, that's just not realistic, and that's probably something that we just don't want to get in a situation where we think they're setting themselves up to miss by over 100 grand a door on the exit.
Yeah, interesting. And
But a lot of
and
it's that, right? It's that, like, a win for us is that we win, but that you win too. And so if we don't feel like it's going to be a win for you, then we generally, probably will just pass and go on to the next one.
that's good. And then we've seen some trends too on just what's allowed. Yield on costs come down certainly. Maybe the requirements that you guys need from the sponsor as far as liquidity. My day was 10%. And maybe enough net worth to support the deal. So where are you guys typically seeing those trends as the markets have shifted?
Yeah, I mean, I think, you know, we really look at the senior lender, right, on a construction loan, because the teeth really is the lender will have a guarantee requirement that requires, liquidity and net worth, like you mentioned. They'll also have a completion guarantee and often recourse too, right? So we generally piggyback off what they're doing. Haven't seen a situation where we've really needed their net worth or liquidity to be higher. In that, the loan is requiring a pretty sufficient level in order to qualify for the loan. And a lot of folks that can't do it, they bring in a co-GP partner who signs on the note and helps them get access to that.
Yeah, and which is part of the reason I'm still bemused by the the reasons that I get that equity's not coming in. I mean, sometimes these loans are so onerous that you would feel like, hey, why isn't the equity coming in? I know they're in second position, but it seems like if you've got some conservative underwriting, you've got a strong team, when is that capital coming back? And so it sounds like you guys are, and it certainly probably is coming back to multifamily. It'll be interesting if it gets back to
Yeah.
some of the office or retail, etc. Go
We're
ahead,
playing
Andrew.
again, we're
Oh
playing
yeah.
mostly in the preferred equity range, right? Not the last, kind of first loss position in the common equity. Um, and so it is, I mean, a lot of the institutional capital is on the sideline right now, or they've moved into the credit space. But I would tell you at the beginning of the year, it did feel like there were some green shoots coming with people wanting to go back. I think everyone was wanting to see another leasing season, see how the spring leasing season went. And then, when the Iran war broke out and, interest rates went up and we started talking about inflation again and, maybe the opportunity to raise rates instead of cut them, it really felt like the last 3 months has just been, a little bit stuck in the mud, right? I think there is capital out there, but it's just really hard to make a decision when interest rates are bouncing around it's a highly levered asset class. And so that really, it really does significantly impact your returns. Sometimes day to day meaningfully. I mean, you told the story earlier of, having to go from 80 to 70, right? I mean, that stuff is real and it's happening. And so, it makes it really tough. I mean, capital really likes, I'm going to say, the perception of stability and surety. It's an illusion for sure because nothing's ever stable or sure. But just in markets, in times of volatility, it's a lot harder to get capital as a whole to make huge bets.
So good. Go ahead, Andrew. I'll save mine.
Yeah. So one of the questions I kind of want to go back to something. I mean, you talked about what you guys do, and we've got some folks that are curious to hear a little more about that. So we're talking preferred equity versus JV equity. What's the practical difference, and when does each one make sense?
Yeah, sure. So preferred equity is really just mezzanine financing. So it's something if you kind of think about, I would liken it almost like a second mortgage on your house, right? Where you've got something that gets you a little bit more leverage and has a fixed return with it. So that's kind of the concept. And then how it would work in the construction world, like what we do is the common equity would go in first as you're building the deal, then the preferred equity would go in, and then the loan would go in last. But then the money comes out in the opposite order. So the loan comes out first, gets paid off in full. The preferred equity gets paid off with both the principal and return, and then everything left is for the common. So from an investor side, why would you want to be in pref? You're really just weighing your downside protection versus your upside participation, right? And so, we feel like it gives us a much tighter standard deviation around our returns. Can't say the word predictable, but just a higher degree of confidence in what the returns will deliver. And then from a sponsorship standpoint, a couple of reasons you would use it. We kind of started off, and when I was talking about the history of Marble, one of the things that, relate being able to raise 35 to 40% of the entire cost of the deal in equity is oftentimes a 30, $40 million check, and that can be very challenging to do. And so preferred equity helps you kind of gap between where the loan, peters out and where maybe your equity raise, especially on the private side, would stall out. And so that's really helpful there. And then, from the additional leverage, the second reason is really the additional leverage enhances your returns. And so, if you have a lot of conviction in a deal, on a development deal today, preferred equity is probably seeking maybe 500 basis points lower returns than common equity is. And so if you were to put a third or maybe half of your equity in pref versus common, all of that benefit, all that arbitrage enhances your returns. And so that's, especially if you've got some high conviction in a deal, you can make it a lot more lucrative by using pref.
So in that example, Brad, just for the audience, if you got a 22 IRR or 20 IRR, the pref is going to maybe take you up to what, 85%, maybe 85%,
Yeah.
80%, and then you're at 15% and paying that instead of your investors on the back end.
Yep. Yeah, I mean that's the market today is probably anywhere from 75 to 85% is what people are looking for in the preferred equity range. Some people are looking for higher. And it's really, everyone's got to manage their own, risk appetite of, leverage is great when it works and it's challenging when it doesn't, right? And so you got to manage that risk. And, we've been very, very fortunate that we've got a ton of great partners that, see the value in it and have continued to see the value in it. And it's been a lifeblood, for our business.
Excellent. Okay, so we actually talked a little bit we talked capital structuring, underwriting, bits and pieces here in some of the conversation. One of the ones I wanted to ask you is about, what are some of the biggest red flags that sponsors, operators that you guys partner with and invest with, they don't really realize are red flags.
Yeah, I kind of alluded to them earlier, right? In that the no alignment and the unrealistic expectation or assumptions. Um, I would assume people understand that not having a track record is a red flag, right? If they have a bad reputation, that's something there. I think the other one, if they are, if it's almost like a spam blast, right? That like there's some groups that I'll get the same deal from, five different mortgage brokers, um, looking for the same, money for the same person at the same time. And that's always, a little tricky, because I don't know who has an exclusive and it just, it's not that something we wouldn't do a deal because of it, but it's just a red flag. It's like, oh, they've gone to the entire world and they've talked to everyone they can and are, blasting it out ad nauseum right now, as opposed to, maybe having a more surgical, tactical approach. Or just trusting, hiring the right mortgage broker, and giving them the ability to go talk to the world about it.
I think that's so good. I'm glad you asked the question again, Andrew, even though he had hit on it earlier, is because you mentioned that there's a perception part of almost everything we do in any business that we're in.
Yeah.
It's how you carry yourself, how you present yourself to the market, the idea that you're willing to just sell out to whoever has that dollar without creating the relationship. So many of those small things, they add up into when to Brad's to get on a call with us and our team, and he's saying, gosh, man, I really like their track record, but they seem in some of their assumptions are just way off, or they may have been working in the 90s and 2000s this way, but this is different now. So there's like a self-awareness part that's so universal.
Yeah.
But when we were talking about, hey, we're going to maybe talk to a couple of brokers that are out there, and, we were very careful in saying, hey, look, whoever we're bringing this out to, it's got to be targeted, because we definitely, if it's not this time and they just see our deal this time by five other brokers and we've got this great deal that comes up next time, they're like, yeah, I remember these guys. You know, it's
Yeah.
very subtle. It's very nuanced the way that you present yourself to the market. I don't know if there's anything else you want to comment to. It's kind of my perception, but
I think that's right. And AI opens up an opportunity for more. I mean, I'm sure you guys have all noticed. I mean, I get way more spam today, now than ever before. So it's, I think it is having it come from someone who's got if you don't have the relationship, it's a warm intro from someone who does, right? That's super helpful, as opposed to being, just someone who's sending it to every email address that's associated with capital in the country, right? And then, I think on that point, if there are groups that you want to get to know, this is a long game relational business, right? I mean, I did a deal with a guy last year that I've known and been talking to for 12 years and never done a deal with, right? And so it was the first one, after spending a lot of time together. And so I think that's, it's important of, finding the groups that you think could be a good fit and, starting to get to know them, starting to tell them your story. Oftentimes that first deal that you show them may or may not happen. But, hearing the story and then letting them, coming back to them and reminding them, hey, we talked about this deal. It's going great. Here's the update on it. We got another couple coming down the road. We'd love for you to, be part of that. Just showing the enthusiasm, the follow up, and the relationship building skills, I think is really important, in this environment where, you know, people want to do deals with people they like. That's not the only requirement by any means. We have got a lot of fiduciary requirements that don't allow me just to do that, thank God.
Yeah.
But I think at the end of the day, you're going to be closer to top of mind if you've got, a great relationship with that person and you've been communicating them the great things you've been doing as you're trying to jump into that institutional capital space.
So let's talk about that because I'm always fascinated by from the beginning of time to through every technology to now to AI. You just hit on it. We've got all these things to make our underwriting look better. Construction management is better. All of our storytelling is better, but it still ultimately comes down to, does Brad know me and like me and trust me or not? There's no AI that I'm going to be able to replicate that. So, as a strategy, if you were just thinking for some people on this call that are seeking better relationships, is there a way that you would focus in on that? Is there institutional guys that may be some of the younger developers and younger should be spending more time on high net worth? Like what strategies, if any, is it maybe kind of becoming a little more sniper like and finding uh, those partners that are more aligned with your faith or whatever that is? What would you suggest to some of the people that are maybe a little bit earlier on in their seeking institutional capital?
Yeah. I mean, ultimately, institutions are going to require some kind of a track record, whether it's yours, personally into that flag, or whether you got it somewhere else and are trying to jump ship into your own thing. You have to be able to demonstrate that you know what you're doing. So if you don't have the reps, you got to find a way to get the reps, right? And it probably does push you to smaller deals, or private capital to help you kind of branch out. But you can take the skills you learn in that private capital, smaller deals, and they are translatable to larger deals, right? So understanding that's key. And we kind of talked about it a little earlier, but if you've got something that's larger that you think is real unique, can you surround yourself with other teammates, that might help you? I mean, you're not going to go, play a basketball game and only have a point guard and a center, right? You want all five players there that round out the team. And so same thing, in putting together a team of credible people that help you cover your gaps, right? I do think it's a bit self-serving, but private equity is a great way to bridge into institutions, right? In that um, you can cobble together, half of your equity from high net worth folks and bridge the gap with an institution that does pref, right? And then you've got an institutional reference, for the next deal, or maybe that groups like us that can flex up and down the capital stack. And the answer might be, hey, on the first deal, we're only going to look at pref because we want to make sure we stay in a protected position until we know you better. And then maybe there's an opportunity on the next deal and the subsequent deal to take a bigger piece, right? So um, it's not easy, but I think it is just blocking and tackling, basic relationship building. That's really helpful.
For those that are skeptical about pref equity taking their deal, right? We always hear the thing is these guys, they come out of the HBS and they're 22, but they're in charge of this deal. Maybe AI has equalized some of that, right? You'd have an analyst that was working for 80, 90 grand now could probably be replaced, but the kind of reputation that a lot of these pref equity guys have in the control and potentially taking over a project, and that the leader of that particular taking over the project is somebody who's trying to make their wares. So how would you answer that reputation? I obviously it doesn't apply to what you guys are doing, but you are kind of at the mercy of what has preceded you.
Oh, sure. I mean, I think, you know, there's certainly some sharp elbows out there. There's certainly some sharks out there, right? And I would just caution you, like, go talk to references of the people that you're going to do a deal with. I mean, we are very user-friendly source of capital. We've been, working with all of our sponsor partners, right, trying to figure out some of these tougher deals. And other groups would just step in right away. But yeah, it is certainly a risk. And so I think it's one of those, maybe thinking about how high up the capital stack do you want to go? I'd run sensitivities of if the world doesn't cooperate, how does that impact my returns? And so those are things that you kind of want to make any investment decision with your eyes wide open. But the reality is it's the people you're with, right? And what are they going to do? When you get in the foxhole, or you want to be with someone who you can trust or you don't. And that's something that, we spend a lot of time trying to earn that reputation. And it's served us well.
It's awesome. Thanks, Andrew.
Okay, so I've got to get this question, and they said we would earlier. It hasn't happened. This has been a great conversation. So, I mentioned to you, we met at Redemptive Real Estate. Faith is a big part of your life. It's a big part of our life. And so I'm gonna pose a question because I think this is out there. Is I said in the beginning, we build thriving communities, and when you say thriving communities, like what does that mean? And it's comes from the basis that investors, operators, and residents can all thrive, and they can thrive at the same time. So, first question is do you believe that? And then the second one is how do you work to integrate your faith into what you
I appreciate the question. Um, Wholeheartedly, I believe that. I mean, I think at the end of the day, rising tide lifts all boats type of thing, where, listen, if we're doing the right thing and we're impacting people well, um, then everyone benefits from it, right? And so, look, you can go into business cases of, for instance, the residents, right? If you're blessing the residents, they're more likely to say good things about you. They're more likely to stay, which has a true operational benefit, right? But that's not why we do it. It's a part of it. But at the end of the day, I think everyone on earth is trying to figure out, how can I be impactful? How can I leave the world better than where it was when I got here? And how can I use, the things that God's put in my purview to do that and to bring him honor and to love on other people. And so I absolutely think that that's beneficial. I think we met through Redemptive Real Estate, and there is an incredible ecosystem and community of people trying to figure this out, right? And there's a lot of different groups out there that are exploring with different ways to serve and love their residents and their employees. And there's groups like Apartment Life and Way Forward where they bring a couple on site, and they will kind of be your welcome wagon, your marketing team, but there's also a faith aspect to it as well. And they're the ones that are creating community at the asset level, or helping create the community, and making sure that people are plugged in, and people that have a friend are more likely to stay. They're more likely to enjoy the resident experience. And that's what I think there's an epidemic of loneliness in our society, specifically after COVID. And so, so many people live in apartments and they've got 300 people next to them. They're behind closed doors and they never say hi to them, right? And so this is a group of people that are trying to connect with those people and get them involved. And there's other organizations out there, Community Growth Foundation, Mission 98, groups like that are they're trying to engage local churches to come in and serve people in tangible ways. I mean, one of my favorite stories I heard, someone talking about getting guys that are auto mechanics come in and service the cars of single moms in the resident community. So that's not something that happened on one of ours, but it's a fantastic story about engaging people and saying, hey, how can you come serve people with your skill set? And by the way, we've got 300 people that need to be served. So come on. So it's been a great community to be a part of. We at Marble are trying to figure out ways to do that. I mean, we certainly put on Apartment Life teams on our deals, and are trying to figure out how to use them as a conduit to bubble up needs that might happen that we might be able to help with financially. And then what we do is we talk to all of our partners about it. I mean, I try to talk to at least one person a week, introduce them into the ecosystem. And I think that's my hope, is that we will be doing it on our deals, but also that in being able to talk to multiple people about it, it'll spread like wildfire, and that, you know, community that we bring to the world will make a difference.
Yeah, I love that. One of the best things that we did, I think, at one of our communities was the car wash. But imagine if we were able to bring auto mechanics there, Andrew, right? Like, wouldn't that be amazing? We got some older folks there. We've got, some single moms. What a fantastic idea. Um, well, thanks, brother. I really appreciate it. You
Thank
know,
you.
learning about what you're doing and how you're helping people. Certainly, my dad he was a basketball coach at New Mexico State. So
Oh,
Las
nice.
Cruces is kind of one of the places, believe it or not, that I have actually been to. Um, but I think it's awesome that you're kind of in this world, and it seems like you're helping a lot of people. I'm sure that Andrew, did we get everybody's questions, or we could probably wrap it up with maybe some questions that we can send out to them. We'll send out the video and hopefully have you back and hear about all of your uh, all of your latest successes. One thing that I've been curious about in the faith-based space is how can we pull all of these pieces together, right? We've got redemptive, I'm part of C12. We've got, faith-driven investor. It seems to be that we've got to figure out ways to help kind of pull these threads because they are helping these communities. There's no doubt that the people that we've got in our community are staying longer, are referring people because there is actual feeling of community, which is what
Yeah.
God
Well,
wants. So,
and listen, I mean, this is their homes, right? And so we get the privilege and the responsibility of loving on people in their homes where it's not like an office where they can leave, right? They're there, and there are real needs that come up, whether it's medical bills that can't be paid, or kids going to college that they can't afford, and so there's a whole host of things, um, tangible needs, financial needs, all of that we have an incredible opportunity to unlock, right? And I do think that's what the redemptive community is trying to do, is to bring all those separate pieces together. So it's something that anyone out there that's listening might be interested. Happy to chat with you on it, or Andrew or Andy, any of that, or you can just look up redemptive real estate and come be part of it with us. We'd love to have you.
Great. Well, Brad, thank you so much for joining us today in the conversation. A lot of good stuff covered. Got some folks' questions answered that had some. Like Andy said, we'll have you back on down the road. But if someone wants to learn more about Marble Capital, what should they do?
Well, you can go to our website and reach out via that way. Happy to, if anyone wants to follow up with me directly, happy to, give you my contact information. I think you can probably get it through Andy and Andrew. Please feel free to ask for that, and love to have a dialogue, learn a little bit more about you, and see how we might be able to help each other out.
Awesome. Awesome. Well, thanks again for coming. Thanks everyone for joining. If you have any questions or want to learn more, reach out to us and we'll help get you connected. And hope everyone has a great day. Be blessed.
Thank you. Appreciate the opportunity.